So we'll start with Frédéric Samama, then Jean-Marie Masse, then Delfina Lopez Freijido, and Haizhou Huang at the end.
Hi.
So let me just introduce the first speaker and then each of them as they go. And some will have PowerPoint presentations, some will not, so the panel will move accordingly so that we all see the presentation. So Frédéric Samama, for many of you, doesn't need any introduction because he is the Nestor, together with Patrick, with all the conferences that we've had in this area. He's the co-head of institutional clients coverage at Amundi. He joined Amundi in 2009. He's the founder of Sovereign Wealth Fund Research Initiative. Before being at Amundi, he oversaw corporate equity derivatives within Crédit Agricole, corporate investment banking in New York and in Paris. He is credited with developing and implementing the first international leveraged employee share purchase program. And his recent focus is on climate change with a mix of financial innovation, exactly what we're looking at here, and has made a number of research policy recommendations. He graduated from the Stanford Executive Program and holds a diploma from Neomia Business School.
Thank you, Jan, and good morning, everybody. In the next 5-10 minutes, I would like to share with you a striking observation. On climate change, we are observing that asset owners are joining the game. Asset owners are increasingly paying attention to this question. And it's something new. It's only over the past 3 to 4 years that the movement started. As Patrick said, when we launched the project 7 years ago, it was a bet, but the bet has become reality recently. And when we try to identify why do we have such a change, we can identify 4 main reasons. The first one is about risk management approach. The second one is about financial innovation. The third is about leadership, and the fourth is about policymakers accelerating the process. So in the next 5-10 minutes, I will describe these 4 forces that are at stake. So when we talk about climate change, no need to be long. Just one graph that is coming from the NASA website. It shows the concentration of CO2 into the atmosphere over the past 650,000 years. And you see it's up and down, but recently it's only up, and it's all due to human beings. And we are all familiar with the impacts on the planet, the fact that the sea levels are rising, the fact that the temperature is rising for sure, and the oceans are becoming more and more acid. So we all are familiar with the impacts of this CO2 increase into the atmosphere. What is, I would say, more interesting for us today is the fact that this question that was at the society level shifted towards investors. And here I would like to refer to 2 thought leaders. The first one is Martin Wolf. In Martin Wolf's article, June 2014, he said, "You investors, you will pay the bill about climate change. Markets being short-term oriented, they don't price correctly the risks associated with climate change. And you cannot count on market signals. You must do the homework analyzing your risks. If you don't, you're exposed to mispriced risks." Another one is Mark Carney, September 29, 2015. He said, "You investors, if you're not integrating climate change-related risks in your portfolios, you're breaching your fiduciary responsibility." So with these 2 thought leaders, we are not talking about saving the planet. We are talking about doing the very basic job of an investor, that is to assess risks. And if these risks are mispriced, that's the responsibility of these investors to sell them, period. Now, what kind of risks are we talking about? Many. We are very familiar with the physical risks. We hear every day about tornadoes and so on and so on. And you have the transition risks with 2 subcategories. Pollution. It's obvious that now you can pollute the planet without being impacted. And you even have reports from the IMF that are making the case that polluting companies are getting subsidized. about $500 billion a year. So the first question for an investor that invests over the long run is to ask himself or herself if this situation is sustainable. Can we pollute the planet and getting paid for that without any risks? The answer is obviously at least a doubt. The other risk that we are facing is about stranded assets. 4 or 5 years ago, an NGO, Carbon Tracker, came with a very simple analysis. They said all these oil or fossil fuel energy companies are evaluated based on their reserves, how much gas, coal, and oil they have under the ground. And they had a very simple idea. Can we take all these reserves and put it into the atmosphere for the next 100 years? Simple question. And here we have a problem. Because if you make the sum of all these proven reserves, you have about 2,795 gigaton equivalent CO2. And if you want to have an 80% probability of not increasing by more than 3 degrees the temperature on the planet, then the budget of the planet is only 1,437, out of which we have already burned 300. So we are using 2,800 to evaluate BP, Shell, Total, and the others, and maybe the budget of the planet is less than half of that. If investors like the Norwegian, Allianz, AXA, and so on are already disinvesting from coal companies, it's mainly due to that, because we all know that between the different fossil fuel energy companies, coal companies are polluting more than the others. So some investors are already integrating this risk in their portfolios. Now the question is how to really shift the portfolios based on this risk analysis. And here comes financial innovation. It's very important because we have to be very humble. We have to recognize that it's not a very easy topic. We don't know exactly when polluting companies will be penalized. We don't know exactly how they will be penalized. So we need to invent instruments that are helping investors do the very first steps. And here are 3 examples. The first one is about low carbon indexes. We are very lucky to have in this room Matt Sanderson, the former CEO of AP4, who has been the very first investor to take this question very seriously during one of the Bellagio seminars that Patrick hosted a couple of years ago. He said, yes, I have equity indexes. And within the indexes, some of the constituents are exposed to climate change. So is there a way to reduce these risks? And low carbon indexes are doing that. Basically what we are doing is that we are screening the different constituents of these indexes and taking out the most exposed corporates, and we replace them with some greener corporates without changing the market returns, without changing the market exposure. So you're generating a form of free option on what is perceived as being a mispriced risk. And the good news is that it works. When we do some backtesting with MSCI, that is in this room as well, you see that over the past 7 years, it will have delivered some significant returns. And the very first important investment that took place in November 2014 has generated such returns over the last 3 years. So, and this technology is now being used by New York Common Retirement Fund, CalSTRS, and very recently, the New Zealand Superannuation Fund, that is one of the best investors on the planet, delivering 21% return last year, has decided to shift 25% of its equity investments toward these kinds of indexes. So what I'm trying to say here is that you have the first easy, transparent, low-cost solutions for investors to reduce their climate change-related risks. Another example of innovation will be described later by Jean-Marie Masse from IFC, who is the brain behind this project. Here, it's about green bonds. We have all heard that green bond is a fantastic tool, it's booming, and it's getting more and more traction around the planet. Problem being that it's only for developed markets. You have very few green bonds in developing markets. And that's a problem, because we need all countries to get mobilized against climate change, not only the European and so on. We need Singapore, we need Mexico, and so on. So we need the financing of the green economy. Problem being that for a lot of investors, it's complicated to invest into emerging market debt before being green bonds. So IFC came with a very innovative structure where they say, let's set up a fund with a junior tranche that we will invest in. So by doing that, we will take most of the risks related to this fund, and it will help investors invest into it, and by doing that, it will channel towards the emerging markets. As the green bond market does not yet exist, at inception, it will be mainly standard bonds. And gradually, over the next 7 years, we will buy green bonds being issued by banks in these countries. A third example is about of financial innovation, is about real assets. We heard a lot about the obstacles. And to be honest, most of the investors do not know about infrastructures. That's a very specific asset class. You know, if tomorrow we have to compare, to make an investment about biomass, wind energy, solar farms, we are just getting lost. There are different business models to try to solve the problems. We heard about infrastructure hubs. We have infrastructure funds trying to grow. You have investors cooperating with each other. And there's the fourth avenue that we are exploring. The fact that we know, we all recognize we don't know, but we know who knows. Corporates. Corporates have the knowledge about infrastructures. And so at Amundi, we are creating a new joint venture with EDF, the largest electricity company, in order to use their thousands of engineers being able to identify and package the projects. So risk management, financial innovation, and asset class per asset class. Third, leadership. You know, when you want to have a shift from one ecosystem to another one, you need leaders. And these leaders must be recognized. They must have all the visibility that they deserve in order to have the others follow. And one of the examples of this leadership recognition is the Portfolio Decarbonization Coalition under the umbrella of the United Nations. It gathers 28 members representing $3.6 trillion and being committed to align their portfolios with the low carbon economy for $625 billion. It sends a very strong signal. $625 billion is a very big amount of money in absolute terms. And it's a very important number as well in relative terms because it's about 20% of the assets. So it sends a signal to the investors community that Allianz, AP4, FRR, and the others are already taking action of shifting their portfolios towards a low-carbon economy. So it means that if you're managing money in South America, in Canada, in the Middle East, and so on, the pressure is becoming on your shoulders. Because if it's true for Allianz, AP4, FRR, and the others, why is that not true for you as well? The third point, and for that we organize seminars and conferences on a regular basis. The fourth point is about policymakers. How policymakers are realizing that here we have a very powerful force, and this force can be accelerated. Concrete example is the Article 173 in France of the law on the energy transition. This law says that all investors, pension funds, insurance companies, banks, everybody that manages money must disclose their climate change-related risks and how they're contributing to the low-carbon economy. It's super powerful because, yes, we have the leaders. We have FRR, ERAF, and the others. But what is being done by some investors is now becoming mainstream. So the policymaker in France is saying, I have recognized this movement, and now I want it to be absolutely mainstream. And we will speak about later about the TCFD under the supervision of the G20. It goes into that same direction. So to conclude, what do we have? What kind of picture? We have a picture about risk management. We have financial instruments. We have mainstream investors already implementing solutions, and we have policymakers accelerating the process. And if you combine these 4 ingredients, you have something extremely powerful. It's extremely powerful because we know that the size of the asset owners being already interested into climate change is about $100 trillion. So it means that each time we get a shift from these investors being already interested towards taking action, we have a major shift of a major reallocation of capital or debt from dirty companies toward green companies. $100 trillion is such a big number that, to put it in perspective, 0.1% is $100 billion. So each fraction of reallocation can have a major impact on polluting companies. Thank you.
We'll continue now with Jean-Marie Masse, who is the Chief Investment Officer of the International Finance Corporation, part of the World Bank Group. He joined IFC in 1994, has over a quarter of a century of direct investment experience on banking, insurance funds, asset management, all across Europe, Russia, CIS, Africa, Asia, Latin America. He is overseeing a global emerging markets portfolio of equity and quasi-equity investment in financial institutions, focused on shareholder value creation. He conceptualized the $2 billion Green Cornerstone Bond Fund, which is a key IFC strategic initiative to stimulate the growth of the green bond market. And he holds an MBA from INSEAD and Master of Science in Engineering. So, Jean-Marie, it's all yours.
All right. So good morning, everybody. So, what I would like to do is to build on the presentation that Frédéric Samama just made and explain 3 themes. The first one, how we see green bonds as a tool. Where is the market currently? Point 1. Point 2, why IFC thinks that a special focus on banks in emerging markets is making sense to create the green bond asset class. And the third point is how we can stimulate the demand and to invest in that asset class and create green bond issuance at scale. Okay? So regarding my point number 1, how we see what are the green bonds. So today, the green bond market is about $160 billion, $200 billion, which represents 0.2% of the total bond universe of 100 trillion. So it's very small asset class in percentage term, but it's a fast-growing asset class. Almost every year, it grows by 30-50% in a volume of issuance relative to the previous year. So small asset class, but growing. What we see is that green bonds, they typically are issued at the same yield as non-green bond. And the main difference between a non-green bond and green bond is not the yield, it's not the risk, because you take as an investor, you take the risk of the balance sheet of the issuer, whether it's green or non-green, so there is no difference in risk. Okay? But the main difference, it's a green bond, it's called defined use of proceeds. And it's governed by the green bond principles, which issue what is eligible to use the proceeds of green bonds. And if you issue a green bond, typically you issue a second opinion, which is released by a third party, which kind of say, yes, the money will be used to finance green assets. And the main assets that green bonds are financing by order of volume so far in the market is number 1, renewable energy projects. Number 2, energy efficiency, which are mainly green buildings. And number 3 is called low carbon transport. So low carbon transport, it's mainly mass transit system, electric scooters, car, bus, taxi. And we expect at IFC that in the future there will be more and more investments in low carbon transport. And it beyond the aspect of climate change, you also have aspect of health issues. Because if you have, let's say, electric scooters instead of combustion engine scooters, then you reduce noise, you reduce pollution by gas in the city and stuff like that. So that's what we see are green bonds. Now, in the current state of the market, more than 56% of green bonds are rated AA or above. So it's a low yield asset class in the most part. And emerging market, in the most part, are below investment grade asset class. So what we see is that there is an opportunity to supply the market for green bond investors with higher yielding emerging market green bonds. So we see the opportunity to create a role at IFC to create this asset class in emerging markets. And our focus based on that is to select banks to help them issue green bonds. And it's a targeted approach. We would like to target banks which are currently issuing non-green bonds and help them opt to issue green bonds instead of non-green bond. That's how we believe we can create an asset class across many emerging markets of green bond at a good yield for investors to buy. So why banks? So there are many reasons. So first of all, it's an asset class at IFC we know quite well. We have about 950 financial institutions in portfolio. Financial institutions represent half of IFC's direct investment in emerging markets. And our view is that systemic bank in emerging market represent a lower risk than what the market perceives for various reasons. Basically, in the emerging market, most of the financial sector, typically 80-90% of financial assets are banks. And the rest is many insurance sector. And typically in emerging market, capital markets are underdeveloped. So if you want to get debt funding for projects in emerging market, it's come from banks. And if you have a major crisis, the IMF is there to come and protect the financial sector to restart the economy. So banks are automatically beneficiary of that support. Okay, so they are regulated. It's a uniform asset class across emerging market. In every country, you have systemic banks. It's a regulated industry. And when we look at green finance, banks are typically a good aggregator of green loans. Because if you look at the financial needs amount-wise for renewable energy projects or buildings, they are not big amount. So bank can provide loan and then agglomerate that on their balance sheet and refinance by green loans. When you do by green bonds, if you look at green bonds as an asset class, if you want to do a publicly placed green bond, typically you need to issue a green bond of minimum $300 million. So at bank level in certain emerging market country, they are the only one who can supply the market with 300, 500, 1 billion, 1.5 billion bond. At individual project level, it's too small to issue a bond. And then the last point on the banks is they tend to be competitive. And many banks, they compete for talent, retention talent, market share. Now there is vast expectation that the green bond asset class will continue to grow. So because in many emerging markets, you don't have green bond issuers today, then you can have a competition to be the first green bond issuer in the market if you are the first bond bank to issue that. Okay? So beside the signaling effect that you care about green finance, you have impact to attract retain talent, and then you diversify your funding base, typically via green bonds with a new type of investors who care about that asset class. So these are the benefits of green bonds for that particular asset class. Okay, so that's what we are seeing to create the market of green bond across emerging market, good yield, systemic, good diversification. Okay? And then my last point is, if we look at how to reach investors, so nowadays investors are quite impacted by low interest rate. So our idea is to create a collective investment vehicle, and IFC is providing a de-risking portion, as presented by Frédéric Samama, because we take a first loss. And that allows to de facto offer an opportunity for investors in the fund to have equivalent of investment grade exposure, even though the portfolio of bond is sub-investment grade. And then to reach the market, we also need size, because many institutional investors would like to invest 100 million minimum, but 10% of an asset class maximum. So that naturally leads you to vehicle of $1 to $2 billion size, which is what we have designed. Okay, and then so that is the opportunity we create to catalyze the market. And then when it comes to helping banks to opt to issue a green bond, we are developing a technical assistance program, donor funded, with 3 components: training for banks, transaction cost cover at time of green bond issuance on second opinion in particular, so that we create the market standard of second opinion in emerging markets. And the third component is knowledge sharing. So we like to focus on research and case studies, because we believe case studies, it's also a demonstration effect to illustrate how we can bring the market behind. So this is our approach. Now we also have signed a strategic partnership with Luxembourg, which to me is also interesting, because 1 year ago Luxembourg launched the Green Stock Exchange, which is designed to list green bonds. And in 1 year, now you have half of green bond by amount listed on the Green Stock Exchange. And so that's also interesting for us to explore what we can do to partner with them and grow their activities, keeping in mind that emerging market is yield and match what investors are looking for. So these were my 3 points.
Thank you very much. Our next speaker is Delfina Lopez Freijido. She's Director of Sustainable Finance for Argentina's Treasury. She has a number of years' experience developing, mobilizing, implementing public policy for sustainable economic and urban development, both locally in Argentina and internationally. She's specialized in sustainable investing as a policymaker, entrepreneur, and consultant. She also served as the manager for investors' assistance at the Argentine Investment and International Trade Agency, as well as working in strategic planning for the government of the city of Buenos Aires. She holds a bachelor's degree in international relations from Di Tella University and a master's double degree in public policy from Institut d'études politiques in Paris and the best American school, namely Columbia. So, Delphine, the floor is yours.
Okay, first of all, thanks for the invitation to participate today, and it's a great honor to be back. So, as all of you may know by now, after Mark's indications, Argentina will be taking the presidency of the G20 next year, or as of 1st of December this year. So the idea is today to share with you a few of the ideas we've been analyzing or exploring for the sustainable finance agenda. Let me say first that in Argentina, in the past year, but in the past years, but mostly in the past year, we have been having some leadership and among different players in the financial system, mobilizing sustainable finance, which helps us embrace this presidency and find it as a huge opportunity to engage with other countries and their experiences on fostering sustainable finance in their countries. So first of all, we see this opportunity, the presidency as a huge opportunity for that, for mobilizing sustainable finance within our country. in that sense, we look to keep building on the work that has been already done by the forum during the past years, but mostly during the past 2 years under the Green Finance Study Group. They have worked on various issues during 2016 under the Chinese presidency. There were various topics covered. Green bonds was one of them. Institutional investors was another one. Laying the ground for further work. This year, Germany has focused more on the issue of availability of data, public available data, and environmental risk assessments. So the idea from us is to keep building on that agenda, trying to complement what has not been covered that much yet, taking advantage of what has been advanced, and trying to be sensitive to be speaking to the times that run and looking ahead of what are the challenges and opportunities that lay ahead in the following years. So, having said that, in terms of focus under our presidency, we aim to work focusing on the opportunities that a sustainable finance brings to mobilizing or helping to cover the investment gap in sustainable infrastructure in particular and in general in development. So that would be kind of the focus we're looking into. And in terms of, so one thing to say where we see the opportunity, because there are various opportunities that sustainable finance brings. From where we are looking at, we understand that there has already quite much capital being committed to that. I did some rough measurements, and the number that I got is kind of 90 trillion. We can discuss a lot about that. Getting a one number that nails it is too hard. But what we've seen is that there are already existing commitments by responsible investors, sustainable investors, impact investors, and a myriad of different types of investors. And while that's a huge opportunity, we see that they still face barriers to mobilize that on the one hand, and on the other hand, something that we've been observing is that people and/or players that are on the pipeline side, on the capital demand side, they sometimes don't even know that these types of investors exist. So connecting those two dots, we think that working on the mobilization of these existing sustainable capital commitments would be a huge opportunity to which the G20 could contribute to. In terms of how we can tackle that, there are various angles, and many questions have been popping up to our minds. I'll share a few of them with you, which I think that, they speak a lot on the topic of the seminar today, and also they're pretty relevant for the various discussions that are going on worldwide. First, and very much aligned to the discussion today, we're trying to see which could be possible ways to repackage loans. As we have already heard, loans and banking products are huge in terms of financing infrastructure in general, and particularly in emerging markets and developing countries. Therefore, we're trying to explore how could these different loans from banks that have been given to sustainable projects be repackaged so that the sustainable capital commitments by institutional investors could jump into the funding for that. So that would be one line of action. There has been much said during the prior presentations. A second line of work that we've been exploring and that we think is complementary is analyzing a little bit the roles of private equity, venture capital, and impact investment, which are quite varied in themselves, in terms of which types of specific roles they could have to finance sustainable infrastructure. And I'd like to do like a parenthesis here when we say sustainable infrastructure, to refer to two trends that we've kind of been seeing. I haven't had any one report that informs me a lot about this, but we've seen two trends going on, and Karim and Wade have spoken a little bit on this. But on the one hand, we see sustainable infrastructure giving space to some decentralization in investment. What we mean by this is by the application of technology on the one hand, but also due to what would make projects sustainable, you end up having either smaller scale projects or new business model for infrastructure, like for example, infrastructure as a service. And that in turn allows or even demands sometimes to look for smaller, more scattered investors. Even we can even speak of less credit-worthy investors in some cases. So there's this kind of trend towards smaller scale or decentralized sustainable infrastructure models, and at the same time, it demands this like a decentralization of investment. So that's one angle. On the other hand, and simultaneously, big projects are still needed and are still on the table. But when it comes to sustainable infrastructure, what we see is that it's not only one big single project, but actually a system of projects. So that demands a whole other range of analysis and innovations. So it is in that sense that we thought it would be interesting to explore the roles of private equity, venture capital, and impact investment funds in all its variety and different shades. Also related to private equity, venture capital, and impact investment, even crowdfunding platforms and various other forms of investment. We see that they could have a role they have a role in funding the development of clean tech and new, more sustainable business models. So exploring that role could be complementary to the other lines of work. And one other topic that we've been exploring, and it's cross-cutting to the rest, but more than only cross-cutting. We think it could be enhancing. It's the role of financial technology, digitalization, etc. We think that they could be enhancers and they could have different roles to strengthen the efforts on mobilization of sustainable commitments by institutional investors, by private equity, by venture capital, impact investment funds, even high net worth individuals and family offices. We think that digitalization and fintech or financial technology in general could bring huge opportunities to enhancing those other efforts. So we thought that in our effort of building working towards the 21st century sustainable finance, this could be a very relevant topic. And last but not least, beyond the specific topics being discussed, the idea is to, in any case, we look to achieve market executable types of products that could help mobilize and involve the private sector. So those would be the ideas we've been exploring. Thank you.
Thank you very much. Our final panelist is Haizhou Huang, who is the Managing Director and Head of Equities Department of China International Capital Corporation. He served previously as the co-head of Sales and Trading Department and the Executive Chairman and Capital Market Committee at the corporation. He has also served as senior economist at the IMF, head of Greater China Research at Barclays Capital, a number of other opportunities. He's a vice president of the China Society of World Economics, a member of the China Finance 40 Group, and a special term professor of finance at both PBOC School of Finance at Tsinghua University in Beijing and Shanghai Advanced Institute of Finance. Holds a PhD degree from Indiana University and a master's and bachelor's degrees both in engineering from China. So he's not the first time with us, and it's great to have you back, Hashim.
Thank you. Thank you, Yang, for the kind introduction. Thanks to Patrick and Fred for the invitation. I want to take this opportunity to provide some perspective from China. Fred already gave comprehensive views about what we should be doing, and Jean-Marie also highlight, the key principles behind green bond finance, and the IFC is doing a lot of that. And so originally, I prepared a PPT focused a bit on green bond financing and also on PPP, but I guess that to save everyone's time, and I will be just talking and focus more on not using slides, but focus a bit more on the PPP. I think that's so much of green bond has been discussed. On green bond, I just want to say that if you look at, our statistics suggest that 40% green bond is issued in China. 40% of worldwide green bond is issued in China. I want to, basically 40% is a very useful, relevant benchmark. I probably will come back to 40%, on a number of occasions. Which is the size of China and why China alone issued 40% of green bond. Over the last 30 years, pretty much actually over the last 20 years, China was able to migrate about 500 million people from the countryside to the urban area. That's the scale of financing that we need to keep in mind, okay? And over the same, if we look at the infrastructure investment, the largest scale on Earth, of course, is in China. More than 60% of nuclear power station under construction is in China. Probably 40%, maybe even closer to 50%, subway lines are constructed in China, as of now, okay? 30 years ago, Beijing, the whole China had one line subway in Beijing under lease of Chang'an Street. So now Beijing has longer subway lines than New York, Paris, or London. They probably in 15 years' time, there is people talk about so Beijing's subway line probably be longer than New York and London combined. Okay, so Beijing is still constructing new subway line. Shanghai, of course, again is longer than New York, London, or Paris. Okay, and then basically that if you think about some of the so-called tier 2 cities, not less is a tier 1 city, and Wuhan, for example. 14 subway lines are under construction. Okay, Wuhan is not most of you probably never heard of Wuhan. Okay, it claims it's China's Chicago, but it's not Chicago. But it's not China's Chicago either. So anyway, but it's a marketing gimmick in a way. But that city is a provincial capital, and it's building 14 lines of subway. Much of that, of course, is financed pretty much alone by China. Okay, that's something that really we need to keep in mind. So in a way that the number of financing that is needed, I think is really mind-boggling. And I think that Patrick traveled to China and saw for example, if you think of the high-speed railway, I think that under construction, 70% is in China, and China is pushing. Probably, aside from France and Japan, from Japan probably in that would account for 20% because none of the other countries have that. Okay, so China's continue to build this high-speed train, and so I think that how China finance that, I think is really the key. Patrick mentioned new institution, new market, and new coalition. I think that the important initiative here is really the PPP. If we think about the key. It's a private-public sector partnership. When there is a need for financing of such massive scale, the largest on Earth, really, China did it alone. You always think about it from economics principle, there is a crowding out effect. You always worry about the very low return on such a longer-term investment. But I think that China solved the problem, solved those two very challenging problems. Number one, I think that on the crowding out effect, which means that when the government invests or public invests, then there is a crowd out the private investment. It really didn't happen. I think that one interesting model China invented to some extent by CDB, which is basically featured in this very interesting article by Patrick Bolton, Fred, and Joe Stiglitz. I think there is a box B, talk about the Wuhu model of CDB. Basically, that China Development Bank, in a way, somehow figured this out, okay? Wuhu, in a way, if you think about the Wuhu, by the way, Wuhu has like 5 subway lines under construction. Wuhu is a tiny city in China in a way. And so it's on the bank of Yangtze River. It's very much undeveloped. The port was outdated. There is no highway, no single mile highway, by the way. So basically that there is backwater of China. And then somehow that, they came out with the idea with CDB. CDB chairman went there and by accident, only by accident, he was traveling to Nanjing, but Wuhu was not very far from Nanjing, so he was invited to visit the place. He saw this place is so underdeveloped and say, CDB probably need to do something. Then the CDB and the Wuhu municipal government negotiated a package, okay, with the help of the Anhui province, which is my hometown. And Wuhu is not even the capital of the province, so it's really a small city in China. They basically gave a whole piece of land that is part of the port and the railway station, everything, and basically give the whole package to CDB. CDB says that we want to issue subordinate debt to finance this. However, after the CDB, of course, builds the new infrastructure, the port, everything, of course, the land value will go up a lot. CDB said that everything in this packaged land will need not only be used as a collateral, but also that the value will need to be captured and shared by CDB, the financier, and the local government. And after they build the railway, they build the other port, of course, the land value went up a lot. They basically sell the land to local developers, private sector. CDB doesn't really get into house building or property development. The private sector then put in a lot of money, finance all this stuff, and that is not only profitable, and actually that the return is really good. There is no crowding out effect. There's a huge amount of crowding in effect. On this crowding in effect, I want to also bring to your attention of a recent paper I published in Journal of Finance by a young PhD from MIT, who basically got this data of CDB, and all the projects financed by CDB. And the users, with sophisticated econometrics, try to figure out to what extent that the CDB investment crowd out, private sector investment. The answer is that most of the CDB investment only bring in, generate the crowding effect instead of crowding out effect, and that's published in the Journal of Finance. Yeah, I think that in a way that the way they did it, of course, is that they get into the early stage of financing. Okay. Using subordinate debt and other kind of debt, and they don't compete when the project is profitable. They don't compete with the private sector. However, they capture the land value or other value and share that value with the local government. So that's really, I think that's really the key. So basically that's the starting point of PPP. And Patrick mentioned about the Hong Kong subway, subway company that is profitable. Also, that the first highway, rail highway built in China was connecting Shenzhen and Guangzhou. When I left China 30 years ago, China didn't have a single mile highway. So the first highway between Shenzhen and Guangzhou was built by a Hong Kong businessman who in the 70s, went to Princeton University. Someone told me as a joke, say that when he was at Princeton, he didn't really study much. Every day he went to the New Jersey Turnpike. I was fascinated by the New Jersey Turnpike because China didn't have any of the turnpike. So anyhow, he went back to Hong Kong. Then he built the first turnpike. It's not a New Jersey Turnpike, which is between Shenzhen and Guangzhou. Highly profitable. Initially, the traffic volume was low. How he become profitable? Of course, he negotiated with the government. Any of the exit. You want to build some rest area. He built the rest area. He said that he built a little shopping mall here. The shopping mall is highly profitable. It's not about he subsidized the highway, indeed. Highway basically is public good. All the profit is captured through the shopping mall on the exit station, and then gas station, whatever. He shared the profit with someone who provided gas. So that model become a model of China's highway construction. Most of the probably half of China's highway actually are in the hand of private companies. Can you imagine that? In Europe, it's probably this can't happen. China is supposed to be a socialist country with whatever, but the highway is privately owned, and a lot of highway are listed in Hong Kong Stock Exchange. It's a publicly listed company, highly profitable. Okay, so I think that by the way, the Hong Kong subway company is also a publicly listed company. okay, in Hong Kong, is highly profitable. So in a way that if we get the strategy right, and really to me is another keyword Patrick mentioned, which is really we need to get the complementarities between the public and private sector. We should avoid the substitution or competition between private and public sector. If we get the complementarities, instead of creating competition between public and private sector, I think there is a lot of value that can be captured, especially through PPP, but also through new institutions like China Development Bank. By the way, over the last 15 years or so, China Development Bank grew from virtually nothing, very tiny place, tiny balance sheet, to be bigger than the all worldwide development banks combined, multiplied by 3. That's the size. Why? It makes all the profit over the period, over the last 15 years. It's bigger than World Bank, ADB, African Development Bank, all development banks combined, multiplied by 3. That's the balance sheet. And it's making a huge amount of profit, okay? Basically, that I think that so in a way that I think that the PPP has a long way to go. Okay, but the key, in my view, would be we need to get a few preconditions right. Number one, we should try to generate crowding instead of generating crowding out. In order to do that, as Patrick mentioned, we need to capture the value and share the value between the public and private sector. We need to basically focus on complementarities instead of competition or substitution. If the private sector can do it, let it do it. Okay, probably private sector can do something better even in many cases. But if the private cannot do it, there is a huge value to be captured. PPP is a very good form. China started to, I prepared a few slides of PPP. I would not be surprised on infrastructure investment. The PPP, if you measure properly, China's PPP financing probably would account 40% worldwide. That's another 40% I will come back. Probably will grow even beyond 50%. So in a way that if you think about China's able to migrate 500 million people from the countryside to urban area over the last 20-year period of time, how much financing is needed? And China was able to do it alone, and that's really, really the key. I also in this case, I think that China in the 50s and 60s tried very hard to push for industrialization. Not very successful. Industrialization need to go together with urbanization. That's again importantly. That's where the value can be captured. Without that, you don't have demand. You don't have level of productivity increase. I mean, you only use, China used a kind of central planning mechanism, Yang, that push for urban industrialization, did not really successful. So basically from 1950s to 1970s, China's urban population ratio was stagnant at about 10%. And that now the urban population ratio reached for 57% if you measure properly. I think that over that course, there is not a profit value to be captured by the public sector and the private sector, and shared by the public, by ordinary people. Their living standard can increase a lot. If you look at the World Bank's measure of, the worldwide effort to lift, the poor out of poverty, I think China's contribution, 80%. If you take China out, probably is negative. Okay, that's more than 40%. You 40% multiplied 2. So I talk about 40%. I talk about 40%. I talk about 80%. I think that's. Let me stop here.
All right. Thank you very much. Once again, China shows it can be done. So we've had a really nice set of presentations from the general, the principles, the applications, multilateral and individual countries. I suggest we open the floor up for a discussion, and we'll start with Flaviano, and then Martin.
I guess it's on. Yeah. Oh, thank you. Thank you very much for such a nice and complimentary presentations. I'm from Brazil, and we have a recent saying in Brazil, which is the following: there is a lot for Brazil to learn from China on capitalism, while they could learn a couple of social policies with us. So Something is completely upside down here, according to this stereotype. Now, the China case illustrates exactly the point that I would like to make, which is the following. It's a missing reference to the need to have the full array of financial intermediaries around the table in order to get things done. And I explain. We will not get it just talking about banks or institutional investors or even venture capital. If one thinks of the range of risks that cut across the different stages of an infrastructure project, starting from the construction phase to the moment it's up and running, the risks change. And the financial institutions have different profiles, different preferences and abilities to cope, to manage, to feel comfortable with each one of those risks. So banks by themselves will not do it. Institutional investors, special funds, will also not do it. Special funds like brownfield investments will not get engaged in the construction. And there we go. So we'll not have insurers at certain moments providing security for the others and so on. To some extent, in my understanding, in a specific way, what the CDB model did was to lump these kind of investors in the Chinese way so that they could take a piece of the pie and the full set was standing. So if we don't have CDB, getting what we want, in my view, we'll have to broaden our reference here in order to have around the table not only banks, venture capitals isolatedly, but indeed to have a pipeline of projects, as highlighted by Karine in the very beginning, that has a role, defines roles, and different instruments to cope with the different risks, so as to have construction and, at the end, infrastructure investments up and running. Thank you.
Thank you, Delfina. Martin? Yeah, yes, there's.
I'd like to follow up on your presentation on China's extraordinary development. We all know basically the story. So let's link what you said with climate. China is the largest emitter by far in the world, and its development has come obviously at the, I won't want to use the price, along with a massive increase in commercial energy, most of it coal produced. So let's assume that China is going to continue to grow. Well, it's growing now, but somewhere between 6 and 7%. It won't continue to grow that fast over the next 20 years, but it's going to continue to grow along very rapidly to reach high income status. That's a very large increase in GDP. We can just debate how big. At the same time, this is only going to fit into the carbon budget of the world if carbon intensity falls. My guess is at the very least by 80 or 90%. Is that possible?
I think that's a very good question. As I mentioned that if you look at the nuclear plant under construction, over 50%, over 60% is in China. There's not much going on outside China. I mean, there's only one station under construction in the UK. Probably that's the only thing what's going on, I guess. Well, that's a joke, he's right, yeah. So my point is that China is massively shifting away from relying so much, too heavily in a way, on burning coal, to basically new form of energy, including nuclear, but also if you think about the solar panel. Again, I think that 40% of capacity is in China, and China is continuing to build new capacity in that area. So in a way that I believe that also that I think China committed to the Paris Accord. China participated in that. China never back off from that. So you travel to China often. I think that if you look at the 13th five-year plan, I was a member to advise the government. They insisted that they will reduce that by more than 20% in 5 years' time in terms of the CO2 emission. I think that with the joint effort, I think they can do it. Again, one important element for China to be able to do that, I think China will be able to move to achieve that is to get the financing right, because it requires a massive amount of financing. And again, here I think the PPP play a very important role. I think that a short response to your question. I think that if had China not had a CDP, I don't think China would be able to go so far. I think this is important. So not only CDP, China developed other important institutions over the last 30 years. So recently I gave another presentation in Europe. So basically that this is, I thought that over the last 30 years or so, okay, China reformed its own banking system, very important, massive job led by Governor Zhou, PBOC. This is important. This is, I think restructure the whole banking system from insolvent to basically among, profitable and among some of the largest banks on earth. In addition to that, I think that's something to me important, but it's not really as important as the creation or developing of 3 other important institutions. Number one, PBOC. PBOC grew out from commercial bank to, I think a top-notch, central bank. And there's a very capable leadership of Governor Zhou. That's very important. Number 2, CDP. I already talked about CDP. Number 3, not surprisingly, CICC, my own firm. Okay. We have China did all kind of restructure. I didn't give Fred this number of PPP because the Chinese government only recently started to push for PPP in terms of using this to help the local government reduce the debt burden and finance the needed projects, subway and so on and so forth. CICC over the last 6 months, we raised 200 billion renminbi alone in PPP. Okay. If needed, we can double that, we can triple that very easily. Okay, that's the new institutional capacity. Of course, we can work closely with ICBC, no problem. We can work closely with the CDB. But there are from policy institution, first of all, we need to get the monetary policy right, which is vitally important in a way. Without that, everything, would be, built on sand, okay? Patrick and I have a paper entitled The Capital Structure of Nation. We show that to some extent, China's capital structure is similar to advanced economies, okay? Which is so different from developing country, which is basically, it doesn't require on foreign debt, okay? So then basically, it get domestic monetary policy right, get domestic inflation condition right, then you can massively leverage up. Okay, that's the key. How to leverage up? You need to create value, capture value. You leverage on the value, not on the debt. That's the key. How? You create a new set of institutions, like Patrick emphasized, use a new set of instruments. I think this is PPP. There is a huge room for complementarity between public and the private sector joint ownership or joint investment, whatever. I mean, I think, so on this climate change, I think I'm confident China can deliver. If China cannot deliver, no other country can deliver. Look at the United States. It's back out from Paris.
All right, here's a challenge. Any other questions? All right.
Hi, so I'm a second-year SIPA student, and my question is primarily about green bonds. So there's a lot of discussion about how green bond yields might eventually be lower than regular bond yields, and so this would make debt cheaper for green bond issuers to incentivize them to fund new projects. My question is around how these green bond yields can be lower in the future. What would incentivize investors to accept them? Do you think post-issuance reporting on transparent reporting on green bonds would help stimulate this? Is this the only option, or are there others? Thank you.
That's a good question, and it's an important point, because we hear a lot about green bonds, and sometimes the messaging around this product that is a fantastic product needs to be very clear. As Jean-Marie said, at the end of the day, there is only one issuer. So what this issuer does with the use of proceeds doesn't change the risk profile of this issuer. To be very concrete, when Apple issues a green bond, it has a different risk profile than the standard bond being issued by Apple? The answer is no. So at the end of the day, there should not be a difference of yields. Green bond is engagement on fixed income. Usually you have engagement on the equity side here, meaning that you engage with the top management, you're sending a signal that you would like this company to do X, Y, Z. And with green bonds, you're doing exactly the same thing, but on the fixed income side. You're sending the signal that you're very happy that this corporate is allocating parts of its activities towards the low-carbon economy. But at the end, there's only one issuer. So is there to be some frictional differences? The answer is yes. Because right now, the demand for green bonds exceeds the offer. But it's just a question of demand exceeding the supply. And you can take this argument or this element to build a strategy, because by definition, we all want this market to grow. So what is very much related to a very kind of market anomaly or a market unbalanced situation is exactly what we want to disappear, because we want the market to grow, and then the unbalanced situation will disappear. So what I'm trying to say here is that doesn't make sense in terms of economic reasons, and it's just due to this very momentary unbalanced situation. So we should be very clear about what a green bond is. It's a bond with a piece of documentation being attached that says we will do that with the use of proceeds. That's engagement. And that's already a lot. But we should not push more than that.
Can I ask you a follow-up question on that? There's some discussion about there could be a step-up clause. So in a green bond, an issuer, if they were able to deliver a better outcome in terms of reducing carbon emissions, so the investor would be incentivized as well as the fundamental producer of the debt instrument. Can you talk about that? And have you had an experience in those types of instruments?
Okay, so maybe I would like to add something. The price, it's a matter of supply demand. So apparently, I went to the Green Bond Principle annual meeting earlier this year. And when you issue a green bond, apparently it's more oversubscribed than a non-green bond. But it's not reflected in the price because apparently a lot of investors are buy and hold investors. So you don't have a lot of trading on the green bond because people want that in their portfolio if they can get the green bond because of lack of supply, and they need that in their portfolio. So now what we were told is that there were 7 billion euro issuance by French government and another multi-billion euro from the French railway companies. And because of the large size of the green bond, you start to see a secondary market trading. And what they say is that you can see 1 or 2 basis point difference versus a non-green bond for this kind of paper. So it's kind of new, but that's what is happening. Okay, so that's what I would like to say about the price issue. Now going forward on IFC side, we believe that there is an opportunity to create a market standard for what kind of disclosure is deemed acceptable for green bond in the market. So today the green bond principle are kind of universal. Us, what we think is that we should start by adapt the universal definition to the specific need of banking sector. It's a way to get there. Okay? And banks are sophisticated enough so that they can produce statistics. So that's where we come from. Okay? Regarding your question, the disclosure would then create the standard for green bond. And then attached to that, you can have greenhouse gas emission reduction disclosure, and you need some science to develop that quite well and be universally recognized as one standard. So today, this function is kind of missing, in my view, in the market, because if you look at the green bond principles, the governing body is 21 institutions, so 7 issuers, 7 investors, 7 investment banks. But they issue guidelines, but there is nobody controlling or enforcing. It's market-driven. So now we need to create template, make them market-driven, and that will push up the sophistication on the green bond side.
Thank you. Would you like to add anything on this side? No. Okay. Do we have any? We have time for one more question if there is one. Otherwise, we're basically there is one. Okay. Very good.
Thank you. A question to Delfina. Is, you mentioned sustainable infrastructure, sustainable finance as the topic for the study group next year. How this is, what is the definition of sustainable finance? How do you go beyond the green dimension of the study group, which has been the focus so far? How this is different from the investment and infrastructure working group sort of definition and area of work?
Good. Thanks for the question. And so a few comments on that. It's not minor. And I was actually going to bring it up based on the question that was asked on the effects on the climate, on the continued growth of China. So coming from a emerging markets perspective and from observing the different paths towards sustainable finance in general in different countries, and in this case, particularly, I'm speaking sustainable finance in a broad term. You can call it green finance, low carbon finance, investment, sustainable investment, ethical investment. In this sentence, I'm going to use it in the broadest term possible. There are various paths to achieving the overall goals that you can imagine everyone having in their heads, like having your capital markets that is sustainable, having the banking system that is sustainable, the regulation that gives those incentives for that, etc. Towards that, there are various paths, and I'll give one small example. When I went back after Colombia to my home country, I had been hearing so many events, so many conferences, and interacting with so many players. And when I went back, my first impression was, oh, there's nothing being done on this in Argentina. But the second I started to take out the lens of what I had before and understand what was happening, I could identify there were actions taking place from the banking side, maybe not so much from the capital market side, because in several countries, banking, as it was said, it's 80% of the, I don't remember.
Banking and financial sector.
Good, thank you. So in that sense, taking advantage of Argentina's presidency, we thought about giving a little bit of more flavor and opening up a little bit more the margin so that the work that we can do on sustainable finance that would incorporate whatever is considered under green finance could give a greater margin to be more inclusive. And that's on the one hand. On the other hand, and related to the question that was asked before, is that oftentimes when we speak about green finance, the relation of, so I don't know how to explain this in a clear way, but we speak about the economic aspect, we speak about the green aspect, and then you have the social aspect. But when we speak about green finance, sometimes the bias comes from, and we can understand that it's between the environmental side and the economic financial side. And the truth is that there is a social aspect within the environmental side in itself that is not related to the economic. And then there is the social and the economic side. And when we think about development and development towards a sustainable development in various countries, you need to give greater space for the social aspect. So we thought that sustainable finance would be a bit more inclusive and more encompassing as a term. So that would be mostly the reasons. But it wouldn't, it's not disregarding green finance at all. It's just understanding that to get to those goals, we might have to give space for different paths. So that would be the rationale behind that.
All right. Well, thank you very much. Why don't we now thank the panelists for an impressive presentation.